Good afternoon, everyone, and thanks for participating in this webinar this afternoon. My name is Chris Brikey, for those who I haven't spoken to before, and I'm the CEO of Stockspot, and I'm going to be running this webinar today. Just before we get started, I wanted to get through a bit of housekeeping first, so you know what to expect. So today's topic is investing in ETFs and how to do that effortlessly. We're using some software called Zoom, which you'll all have seen now and downloaded. It's pretty simple to use. If you want to just relax and listen to the webinar, you're welcome to do that. Otherwise, you'll see at the bottom of your screen there's a Q&A button, and if you have any questions during the webinar, feel free to ask them using the Q&A function. We have Sarah, who's our head of client care and advice at Stockspot, on hand to answer any questions you have during the webinar. I'll also try and answer a few at the end of the session, and any that we don't get to today, I will try and email a response to you personally over the next week or so. So do keep the questions coming through. We will do our best to answer them. So a couple of other last points to make. So first of all advice that we provide in this webinar as well, we need to point out, is general advice only. So I don't know your personal circumstances, and so not all of this advice will be relevant. And also, we won't be providing any specific advice on particular ETFs to buy or to sell. A lot of today's webinar will be focused on the general principles of how to select ETFs, or at least how we select ETFs for clients at Stockspot, how we go about it, and what we look for in a general sense. So we won't be specifically recommending any products. So before we get started as well, I wanted to give a little bit of a brief background as to who I am. So as I mentioned at the start, I'm the founder of a business called Stockspot. And also as a result of starting this business, which was the first online investment advisor and fund manager in Australia, I'm sitting on a couple of advisory boards for the regulator in Australia, which is the Australian Securities and Investments Commission. And before I started this business, I worked as a fund manager at UBS, and before that at another fund called Blue Lake Partners. So I've been a fund manager for a lot of my career. But what really excited me about 5 years ago was the emergence of ETFs in Australia. So it's fitting, I think, that this topic today is on ETFs, because it's something I've been very passionate about for the last 5 years. And ultimately, I think ETFs will radically transform the investment landscape in Australia over the next 5 years. They already have had a huge impact since I started this business 5 years ago. So when I launched Stockspot, the total size of ETFs in Australia was around $8 billion. And as of last month, that is now $42 billion. So there's been phenomenal growth. And some of what you learn today will hopefully give you an idea of why that growth's been happening. So there's 4 topics I'd like to cover off on today. So the first topic is just a very brief background on what ETFs are. And I know some of you will have come across them before, or you're already investing in them. So hang with us. We're not going to spend too much time on this, but just for the benefit of those who don't know too much about ETFs. Then I'm going to be speaking a little bit about diversification, why it's important when you're investing, and then also how ETFs can help you diversify. And I'm going to be speaking on 4 different ways you can diversify with ETFs. The third topic is how we at Stockspot select ETFs for our clients, which can give you a few ideas of what to look out for, not only when you're picking the right ones for your portfolios, but also ETFs that we try and avoid, and the reasons we avoid those ETFs. And then finally, I'm going to go into 4 simple tips, which I think anyone can use when thinking about ETF investing or investing more broadly. And hopefully these tips will give you a few ideas of how you can achieve better results with your investing. So first of all, what are ETFs? So ETFs are now, as I mentioned, a pretty fast-growing part of the Australian share market. About $42 billion is invested in them. And one of the reasons why they've been so popular is that they give people really simple and easy access to hundreds or thousands of different companies with a single trade. So they allow you to invest in lots of companies within one market, rather than just picking individual shares or individual bonds. So ETFs track an index within a particular asset class, and that index can be a share market index. So a lot of you will have heard of the ASX 200, which is the biggest or most commonly used index for Australian shares, or it could be an index that tracks a different asset class. For instance, in Australia, the composite bond index is the most commonly used index for monitoring how bonds do in Australia. So ETFs invest in a wide range of securities within a certain asset class. And so one of the benefits versus investing in individual shares is that you really get to spread your money across lots of different investments rather than just pick a few. And there's also some big benefits versus investing in a traditional managed fund, particularly the costs of ETFs. So ETFs have much lower fees than traditional active funds, and I'll go into a bit more detail on that next. So ETFs actually have some similarities with shares and managed funds, but they also have some differences. And so I just want to talk about those briefly. The main differences between a share and a managed and a share and an ETF is that you get access to lots of different investments. So similar to a share, ETFs trade on the stock market. There are now about 180 ETFs listed on the ASX. So they look and feel a bit like a share. They trade during the day, but rather than accessing a couple of investments, you get hundreds or thousands at once. Then they have similarities to a managed fund or a mutual fund, as they call them in the US, which is that they do give you access to a lot of companies. The main difference with an ETF is that rather than having a fund manager try and pick the right stocks or try and time when is the right time to invest, an ETF doesn't decide on that. It simply says, we will give you access to the whole market and all of the shares within the market. The benefit of that is twofold. So one, you'll always know what you're invested in. So ETFs publish always what the underlying investments are, and so you can understand what's in your portfolio. But then as a result of not having to hire expensive fund managers and analysts to pick stocks, the fees of ETFs are typically much lower than an actively managed fund. So most active funds in Australia charge somewhere, like 1% to 1.5% in fees per year. The ETFs that we use and recommend are typically charging about 0.25% per year. So a quarter to a sixth of an actively managed fund. So that's some of the similarities and differences versus the ways that people would traditionally invest, and how that's different with an ETF. Now, two of the reasons why ETFs have been really growing phenomenally has been, one, they give you that great diversification, but two, more people around the world are realizing that it's very, very difficult to pick the right shares or try and time the share market. And this realization really has accelerated since the financial crisis, because people realized, who had given their money to expensive professional fund managers, that these people had no better shot at beating the market when markets fall or when markets rise. And a lot of academic work has gone into researching this and actually found that giving your money to a actively managed fund actually won't give you better performance in down markets or up markets. And that might surprise quite a few of you, because often the message that active fund managers sell is that when markets get tough, we'll help you outperform the market, or we'll help protect your money. The evidence doesn't support that this is actually possible, or that any fund managers are really consistently achieving this. So in the financial crisis, in the US, where the average fund manager was investing, in the financial crisis, the average index fund, or ETF, fell by 50%, which was what the market fell by, and the average actively managed fund manager also fell by 50%. So if active fund managers can't save you when markets fall, there's really not a lot of point paying them extra fees for the rest of the time you're invested with them. And this realization has seen a huge amount of money move out of actively managed into indexed or passively managed ETFs over the last 10 or so years. This chart really shows the extent of that change. So there's actually been trillions of dollars moving out of active into indexed. And this is something I truly believe will continue for many decades still, and has only just begun. And it actually will not have completed until there's a lot less competition within the funds management industry to pick stocks and time the market, because at the moment it's way too competitive. There are too many people doing it, and not enough extra return to share around between these people. So this is a trend that's here to stay. And in Australia, we're actually behind the rest of the world. So you're all probably quite a long way ahead of the curve compared to the average Australian, I think, in realising the benefits of ETFs. In Australia, even though it's $42 billion in these now, that still only accounts for about 2% of our whole share market. Whereas in the US and Europe, that's already in the 10s and 20s and 30s%. So we're punching behind. But Australia is catching up pretty fast, and I think a lot of money will be invested in ETFs over the next 5 years. So now that we've had a bit of an overview of what ETFs are and what they allow you to achieve, I'm going to talk a bit about diversification. Now, diversification, when you're investing, is about spreading your money across different investments to, one, give you the opportunity for better returns, but also, and probably more importantly, to reduce the risk in your portfolio. So when you invest in anything, you need to accept that markets go up or down, and that over short periods of time you can lose money. The beauty of diversification is that it can reduce those down periods in your portfolio. And I'm going to talk about 4 different ways you can do that using ETFs. So first of all, and I've talked about this a little bit already, but when buying shares in Australia, in the past, you'd typically pick a few companies to have in your portfolio, maybe 20 or 30 even. You'd have some banks and some BHP and some Woolworths, and these would combine into a portfolio. Now, there is a big risk when building a portfolio with individual shares, and that risk is really illuminated in this chart on this slide. What this basically shows is that over the last few decades, since 1980 actually, most of the returns that have been generated in the share market have been generated by just 4% of companies, so 1 in 25 companies. And all of those big bars on the left-hand side of that chart are companies who have actually done worse than the market, and many of them have actually lost you money. And what does this mean? Well, it means that if you were to pick any shares at random in your portfolio, there is a much bigger chance that most of the companies in your portfolio are actually going to lose money or do poorly. And it's only going to be a very small number of companies that generate all of the performance of your portfolio. And this is something that not only has happened over the last 20 or 30 years, but a similar study has shown the same since 1926, that almost all of the share market returns have come from a few companies. So when people look to pick shares in their portfolio, one of the emotional fears that people have is having bad companies in your portfolio and trying to avoid the losers. But this is a mistake. When you're investing, you shouldn't be trying to avoid the losers in your portfolio, but you should actually just be making sure that you have the winners in your portfolio, because those winners will give you much higher returns and generate the bulk of your performance, and be easily able to overcome those losers. The risk is if you don't have those winners that are generating all of the returns, your portfolio isn't going to do very well. And this is one way ETFs can help you. So ETFs don't try and pick and choose what are the best companies. They invest in all of the companies. So the example I've shared on this slide is the Australian shares ETF that we invest in, that invests in the 300 largest companies listed on the Australian share market. Now, not every one of those companies is going to do well. However, those few companies that do exceptionally are the ones that are going to give you most of your return when you invest in Australian shares. And we know that over the last 100 or so years, the average return of Australian shares per annum has been about 11.5% per year. But this hasn't come from a wide range of companies. It's actually come from quite a concentrated number. So that's one way that ETFs help you diversify. They ensure that you're invested in the companies generating most of the market returns. Now, this slide talks about the second benefit of diversifying using ETFs, and that is that not only do ETFs allow you to invest in shares, which a lot of you will be familiar with, but also ETFs allow you to invest in other assets, and other assets that have historically been pretty hard to invest in. So one of the things that really excited me when I started Stockspot is that bonds as an asset class were now available for anyone to invest in via the ASX through ETFs. And what that meant is that anyone can now invest in the most valuable asset historically for mitigating losses when markets fall. Historically, bonds have been one of the best cushions when share markets fall to help support your portfolio. And this chart shows that in the worst 10% of months since 1992, where our market has fallen 5.8%. So actually, anyone that was watching our market in October will notice that that month was one of the worst 10% in Australian shares. Well, what you see in those periods is that assets like bonds, cash, and gold are actually able to rise in value and actually protect your portfolio somewhat. So this shows that the average month where Australian shares had a bad fall, Australian fixed income, which is bonds, had an up month of about 0.5%, and Australian cash a little bit less than that. And actually, as a great example, last month when Australian shares fell by 6%, gold, which is another diversifying defensive asset that we have in our portfolios, rose by 5%. And this helped our clients' portfolios absorb some of the market losses. And always markets are going to go up and down. What we think is a lot more important is making sure that when they go down, that your portfolio goes down by less. And so you are not facing that emotional roller coaster ride as much as everyone else. And getting access to defensive assets through ETFs is one of those ways. Here's just another chart that demonstrates how that works in practice. So by adding bonds to your portfolio, and you can see on this chart on the top right-hand corner, there's a blue dot, and that represents a portfolio of only Australian shares. And over the last 50 or so years, that has returned about 10% a year, but had risk or volatility of about 16% a year, which means you're going to wear some pretty big ups and downs along the way. And now, just by adding 20% of your portfolio into fixed interest bonds, and which you can do in an ETF these days, you're able to reduce the bumps in your portfolio by a significant 3%, but you're only giving up about 1% in return. And this really goes to the heart of diversification, which is that by diversifying, you can take a lot less risk to earn a pretty similar return. And sometimes the return will even be better. So the third way that ETFs help you invest is actually by helping you access better returns. So the last one was about reducing risk, but many of you will have noticed that over the last 5 years, Australian shares have had pretty lackluster performance. Our market has been actually one of the worst performing around the globe over the last decade. Now, ETFs allow you to invest in markets outside of Australia, and this is something that most people have found quite difficult in the past. Some Australians will have gone to well-known global fund managers to do this, but ETFs now allow you to do this in a much easier, lower cost and transparent way. And so you can buy an ETF that allows you to invest in the US market, the S&P 500, the German market or European markets, Japanese shares, Chinese shares, or any of these global markets. And by adding some of these global markets into your portfolio, they can help you earn returns even in periods where Australian shares aren't doing too well. So this is the third way, giving you access to global share markets. And now the fourth and final way that ETFs help you diversify to help increase your return potential and reduce your risk is through spreading your money across different sectors. Now, again, anyone who has Australian shares in your portfolios will be aware that there's a couple of sectors that punch above their weight in Australia. And one of them is financials, because we have such large banks here. And the other is materials, because mining is a big part of our economy. Companies like BHP, Rio Tinto, and Woodside make up a large proportion of our market. And this chart here shows the different sectors in the Australian share market at the moment. And what you can see is that, yeah, those two sectors, financials and materials, make up a huge majority of the market. They make up 50% just in those two sectors, which is much larger than the overall global economy. What does this mean? Well, this means in periods when financials and materials aren't doing well, the last 5 years was a great example of that, then your portfolio isn't going to perform well. And ETFs allow you to tailor your portfolio into other sectors of the global economy. To give you one example here, a sector that's very much underweight in the Australian share market context is the technology sector. Now, I recognise this is a pretty hot sector at the moment, and a lot of people are very excited about investing in this. Unfortunately, there weren't more people excited about investing this 5 years ago before this sector had a huge run. But regardless of how it's performed recently, it is a sector that's underweight in the Australian share market, and a sector that may make sense to use ETFs to access. So the example I give here, and there's actually quite a few technology-focused ETFs. This one is a beta shares ETF, which is the NASDAQ 100 ETF. It invests in the largest 100 companies on the NASDAQ exchange, which is generally a technology focused exchange in the US. And this ETF allows you to focus and invest in technology stocks. I should also point out that we don't think you necessarily need to use sector ETFs in your portfolios. In fact, we don't do it for our clients, because we think by adding some global share market ETFs to your portfolio, you can actually address a lot of those sector imbalances. So just by adding, for instance, emerging markets to your portfolio and the global largest companies in the world to your portfolio, that already adds quite a lot of technology back in. And so you don't need to specifically add technology into your portfolio, although it may be for people who want to have a more active approach to investing, it may be something you want to do. So the next topic I want to talk through is how we select ETFs for our portfolio. So now that I've explained why diversifying is important and how ETFs can help you do that, a question you probably have is, how do you pick a good ETF? Which is a fair question, because there's now close to 200 ETFs listed on the share market, and a lot of them essentially sound very similar. There are dozens of ETFs that allow you to invest in Australian shares, and even more that allow you to invest in global shares. So picking the right one is a pretty important decision. Now, we've been researching ETFs for the last 5 years or so, and we produce a research report that is available on our website. Anyone can download it, where we talk about this in detail. So this is just going to be an overview of how we consider the ETFs and some of the factors we think are most important. Now, this slide looks at the 5 factors that we look at probably more closely than any others when we're selecting ETFs for our clients' portfolios, and I'm going to talk through each one by one. So first of all, is fees. Now, this is a pretty obvious one. One of the big benefits of investing in ETFs is that they are low cost. So investing in something that charges a small fee every year versus a large fee, what you'll generally see over the long run is that you'll earn the benefit of that difference in fees. Now, generally, we look for ETFs that have fees of around 0.25% per year or less, which is quite a low fee. Now, there are examples of ETFs that you are not able to achieve this, and an example of that is emerging market shares. So emerging market shares is a more expensive market for the ETF issuer to manage and to get access to, and so the fees for that particular ETF are a little bit higher, but generally we're able to build portfolios with low fees of under 0.25% per year. The second factor is slippage. This one is a little bit more nuanced, but it's in a more simple layman's terms, it's basically the cost you pay when you buy the ETF on the ASX, because you have to cross across and buy it off the best seller. And the wider the distance between the best buyer and the best seller, the more your slippage and the more you lose when you're investing in ETFs. Now, we're very careful when we're buying ETFs during the day to try and do it with the smallest amount of slippage, which sometimes involves doing it at a particular time of the day or just being patient and waiting. But what we'll look for is generally ETFs that throughout the whole day have an average slippage of less than 0.25%. Now, a lot of the big ETFs match this criteria very easily. So the big Australian shares and US shares ETFs now tend to have slippage of less than 0.05%. So, even a 20% of this But even for the less popular and less liquid ETFs, we really think a slippage of less than 0.25% is something that's beneficial. Otherwise, what you can end up doing is paying more than you do in a whole year's worth of fees that moment that you buy the ETF, which doesn't, won't really help your portfolio start to generate returns immediately. The third factor is liquidity. So liquidity, in simple terms, is just how much an ETF trades, but it's a little bit more complicated than that. So there's a few ways to measure liquidity. The most simple is just looking at how much an ETF trades per day or per month. And what we like to look at is the daily trading volume. And we've generally try and find ETFs that have trading volume of over about $500,000 per year, because for our purposes, this provides enough liquidity to be able to make sure that we can get in and out and not rely as much on market makers. And market makers is a starting point to the second area of liquidity, which is that when you're investing in ETFs, it's a bit different to when you're investing in direct shares. When you invest in direct shares, typically when you're buying, you'll be buying off someone who just wants to sell because they want to get out, and vice versa. When you're selling to someone who is just an interested buyer. With ETFs, most of the time you're buying and selling. It won't be buying and selling against someone else who's trying to do the opposite. It will be actually against a market maker. Now, market makers are actually paid by the ETF issuers like Vanguard or iShares or BlackRock, and they're paid to sit there in the market and make sure that anyone who wants to buy or sell can do so in a low-cost way and in decent sort of size. Now, market makers are great and they serve a fantastic purpose. However, ideally, you don't want to have to rely on market makers. And if there is natural volume in an ETF, that is better because there is a small risk then at the time that you want to sell, the market maker may not be there in the market. Now, I should say that is a very small risk. Market makers have a contractual obligation to be making a market within a certain distance between the hours of 10 a.m. and 4 p.m. when the market's open in Australia. And if they don't, the ETF can actually risk being delisted. Now, this has never happened, so it's not something that's common or likely to happen. But it's one of the reasons why you really want to find an ETF with natural liquidity. The fourth factor is size. So this one's a bit more simple to understand. We look for ETFs that at least have $25 million under management. And the reason for this is that ETFs that don't get enough critical mass sometimes shut down because they're not commercially viable. And this has happened before quite a few times. Even this year, there's been several ETFs that have shut down. And this has annoyed investors in these ETFs because they're forced to take capital gains or losses and then go and try and find a similar ETF. 25 million we've chosen because this is a figure where generally if an ETF is over this size, they're self-sufficient and they can survive. Below this, there are questions of whether the ETF is going to be viable in the long run. Now, of the 180 or so ETFs listed on the market at the moment, about 130 of them do meet this criteria and are over 25 million, which means there are 50 ETFs in Australia that are really too small unless they get more critical mass. And they're typically ones that we'll avoid until they have a bit more critical mass. The final factor to pay attention to, and this one isn't as relevant in Australia because the ASX is fantastic at making ETFs be quite transparent about this, but it's counterparty risk. Now, this is about whether an ETF actually owns what it says on the label, or whether it has a financial contract with a bank to give exposure to what it says on the label. So when we invest in, for instance, the Australian Shares ETF, that ETF owns all of the underlying shares. So it's backed by those shares. Similarly, when we invest in the gold ETF for our clients, that gold ETF actually stores its gold in a vault in London. So it is physically backed. However, that's not viable for all ETFs. For instance, with an oil ETF, it's not very viable to store large amounts of oil for an ETF. So rather than doing that and maybe hiring a ship and leaving it on an offshore ship, what happens is that the ETF issuer will have a contract with a bank to guarantee them the price of oil. Now, this isn't a huge risk generally. However, occasionally, banks that have these contracts face financial problems that then puts your money at jeopardy. So an example from the financial crisis was Lehman Brothers. Now, Lehman Brothers was the counterparty on many financial products. And when Lehman Brothers went bankrupt, there were questions over whether owners of those investments would get their money back. And ideally, as an investor, counterparty risk is a risk that you don't want to take. Anything that you invest in, you want to have physical backing of what that investment is. And this is something we focus on. Fortunately, the ASX requires any ETF that doesn't have physical backing of at least 90% to disclose this. And so this is something that's quite easy to see. And there's very few ETFs listed on our market that have a significant amount of counterparty risk. In fact, I think it's less than 10 or so at the moment. And most of them are commodity ETFs where it's simply not viable to own the underlying. So for anyone that's interested in more around the detail of ETFs and how we choose them, this report's available on our website for anyone to download. This year, a couple of the key findings that we discovered when researching ETFs. First of all, Vanguard, who a lot of you will have heard of, it's the biggest ETF issuer in the world now, or very close to that. It's the fastest growing ETF issuer in Australia, and we think this makes a lot of sense because their ETFs are simple, they follow broad markets, they have a consistent philosophy of investing in broad markets and not getting swept away with the latest fads, and they have a great track record of reducing costs for their clients. So we have many Vanguard ETFs in our portfolios, and we think they're generally very good. Another trend that we've seen is that actually for the first time ever this year, ETFs investing in global shares overtook ETFs investing in Australian shares in our market, which really shows that a lot of self-directed investors and investors using ETFs through services like ours are now realizing the benefits of getting global exposure, not just Australian exposure. And finally, the last trend, which I'm going to speak to in a bit more detail, is that there's a whole bunch of new funky ETFs coming out. They all have great stories behind them, and often they're in these new categories of smart beta or active ETFs, which means that rather than tracking just a broad market, that they're tilting the portfolios to certain market factors like growth or momentum, or they're giving that money to an active fund manager to invest. And what we generally find, and definitely we found in this year's research, was that most of these ETFs do worse than just the simple broad market ETFs. In fact, there's quite a few active ETFs listed now, but both in the Australian category and the global category, we didn't find a single one that had consistently beaten the very simple index ETF. So there's a lot of funky products coming out, but that doesn't necessarily mean that they're good products for investing in. Which takes me to the next slide, which is what do we look for when it comes to ETFs to avoid, or what are we cautious about? And I put that into 5 categories. So one, we're very cautious when a new ETF lists that has not existed before, but has a back-tested strategy. And the reason for this is that it's always easy to get a good result in backtesting, and you'll never see a bad backtesting result. So there is a selection bias here that makes this pretty useless information. In finance, we call this p-hacking, which means that you can basically probability hack to make anything look good in the past. And why we're cautious about this is that it really gives you no information about what's going to go on in the future. And in fact, many ETFs that may have looked good in backtesting are likely to perform poorly going forward because of what's known as mean reversion. So things that do well for a period often then don't do well for a period. So you shouldn't look at backtesting and think that means an ETF is going to do exceptionally well for a longer period. If anything, we think you should be cautious about that. The second is a group of ETFs which are categorized as structured products. Now, again, the ASX requires that you actually, that the ETF issuers put this on the ETF label. So any ETF that is a structured product, you should see the letters SP after it when you search it online or when you look at their product. Now, structured products similar to active ETFs and smart beta ETFs are generally complicated. They're generally higher cost, and they usually have more nuanced strategies. Because these strategies are more complicated and have higher costs and often involve hedging or trading more often or using futures, the result is that they generally don't do very well either. And there's some great examples of this. One that we've been critical of since it's been available is an ETF called Dividend Harvester ETF, which has a fabulous name and a great story, but it's been a perpetual underperformer. And we think a lot of this is due to having an overly complex product that's hard to understand, high costs, and a strategy that doesn't make a lot of sense. I've mentioned active and smart beta ETFs, so I won't linger on those for too long. And I've also talked a little bit about why we avoid small ETFs, because we don't want to risk them shutting their doors. The final thing that we look out for is ETFs that are chasing hot trends in the market. Now, when it comes to manufacturing any financial product, and ETFs are included in this, the manufacturers of financial products typically follow a pattern of launching products when there's the most consumer demand. Consumer demand then tends to follow when certain ideas or investments have done well in the recent past. So what you see in ETF land is typically new ETFs that launching in areas that have done quite well in the recent past. Now, a good example of this a couple of years ago was that there was about a dozen yield or dividend ETFs that came out around 2015, 2016. This was because at that time, dividends and yield was a very popular area. There were a lot of retirees and self-managed super funds looking for dividend yield. Telstra shares were trading very high at $6 or $7, and people had made a lot of money, and people were hungry for dividends. However, this actually was the worst time to be investing in dividends as a strategy. And as some of you will be aware, shares like Telstra and the banks and other high dividend paying investments have been some of the worst investments over the last 3 or 4 years. And dividend ETFs have also performed very badly. And this is a great example of when the new ETFs are following what's hot, but not necessarily what's good. And right now, what we're seeing is a lot of technology-focused ETFs. Every week, I feel like I see a new one of these, whether it's an Asian technology ETF or a robo ETF, or there's all sorts of ETFs coming out with different slants on technology. What concerns us is that they're all coming out after a period of 10 years of very strong growth in the technology sector. So they're piggybacking off consumers being hungry for these, which makes us cautious to be investing in them. And for that reason, it's not something that we look at, ETFs that are popular and that everyone's flooding into. So now that we've covered off on those, I just want to spend another 5 or 10 minutes on this last section, which is a few tips for your ETF investing. And then after that, if there's any questions, I'm happy to take some questions as well. So tip number 1 when investing in ETFs, and I've talked about this a little bit already, which is that you can get a lot of benefit by simply adding 2 things into a portfolio of Australian shares, which are fixed income or bonds and global shares. And both of these can be accessed via ETFs, and it can really give your portfolio 2 things, which is the opportunity for better returns and also lower risk. The chart on the left-hand side here is what we use to illustrate how we try and achieve this with our portfolios. So you can see that compared to a portfolio of 100% Australian shares, our portfolios, we do not expect to return the same amount over the long run as Australian shares, but Australian shares are a lot more risky. And what we think we can do is achieve pretty decent returns with a lot lower risk. And over the last few years, this is what's happened. And we've done this by having global shares and bonds in the portfolio, as well as gold, actually. The chart on the right-hand side demonstrates this as well, which shows a diversified portfolio in bonds and global shares as well as Australian shares, the blue line, versus a portfolio of just Australian shares, the green line. The period isn't shown here, but it's a period of 2015 and 16. And what you can see is the Australian share line, the green line, is a lot more volatile. There's a lot more ups and downs, but also it performed more poorly over that period. Now, diversification, I should point out, won't always give you better returns. In fact, this was a bit of an anomaly because global shares were doing so well. Generally, what you can expect from diversification is similar returns, but lower risk. I thought I'd provide a bit of an example to explain this in a bit more detail. So these are the asset allocations recommended by 8 of the world's most famous investors. So you'll probably recognize some of these. Warren Buffett recommends that people invest 90% in a low-cost US shares index fund and 10% in a bonds ETF for the long run. Whereas Ray Dalio, another famous investor, came up with the all seasons approach, which has a 30% split in stocks, 55% in bonds, and 15% in real assets, which are things like gold and property, so physical assets. So what you can see is that these recommended asset mixes between the different assets are quite different. What you may be surprised about is the next slide. Actually, if you look at the performance of these portfolios over very long periods of time, what you see from these lines is that they've actually performed pretty similarly. So even with big differences in your asset allocation, your long-term performance is not likely to be hugely different as long as you're consistent with your strategy. The other point I should make here is that the best strategy here, which you can see was the orange line of having 90% US shares and 10% in bonds. If you added a fee of 1.25% per year to that return, which could come from speaking to a financial advisor that's expensive, or from paying for subscriptions or all sorts of other trading courses. If you paid that amount in fees every year, you would go from having the best performing asset allocation to the worst performing asset allocation. So the point here is that getting some global shares and bonds in your portfolio is important, but if you do that in an expensive way, you lose all the benefit and some. The second tip is rebalance your portfolio. So this is something we do automatically at Stockspot, but the principles can be applied to anyone. So what you find when investing in a portfolio that mainly has shares and bonds in it is that over a period of time, because shares do better than bonds, the share component of your portfolio will get bigger and bigger relative to the bonds, which you can see on the chart in the middle of the screen shows the blue area overtaking the purple area. Now, this can be good because you're earning good returns in those shares, but it also means that your portfolio is getting more risky every year. So if you don't rebalance, which means selling the investments that are doing well and buying the investments that haven't done so well, your risk in your investments keeps on getting larger and larger and larger. This might not be something you notice immediately, but if there's a big market fall, that's when it's going to sting you. So what we do, and that can be applied to investing for everyone, and is what we really believe is best practice now when it comes to investing, is to rebalance your portfolio when the investments in your portfolio move substantially from what you've set as their target weights. So for each of our portfolios, for instance, we set what we believe is the right target weight for the amount of risk and return we're trying to generate. And when a client's weights in those assets vary substantially because markets move, we will rebalance that automatically to get it back into kilter with its target weights. And this is something that anyone can employ and will help your investing and help to manage some of those emotional biases as well. It's very easy to get swept up in a booming share market and be tempted not to rebalance, which is also why we recommend that rebalancing should be something that you set automatically. So it shouldn't be something that's affected by your emotions, because usually the best time to be selling and rebalancing out of things that have done well is the hardest time to be selling, because that's when everyone else is excited about it. That's when everyone else is writing about it in the newspapers. You're going to feel silly selling, but it's the smartest thing to do to reduce your risk when things have done well. Tip number 3 is another one to try and manage your emotional biases when investing. Now, one of the questions we get most often from prospective clients is, how do we know when is the best time to invest? Should I be investing now? Should I be waiting? I've heard something in the news that markets might fall. Should I buy or should I wait? The truth is, no one really knows what markets are going to do today, tomorrow, next week, next month, or even next year. In fact, markets only go up 60 or 65% of years, and so there's a lot of years that markets go down, which means that when you're investing, you need to accept that markets are volatile and go up and down in the short run, and you really need to have a long-term horizon in order to achieve good results. Now, this can make investing difficult to get started doing because you're always waiting for the right time to buy, but this this procrastination can actually be quite dangerous, because if markets don't do what you think they did, you could be waiting a long time and never purchase. Dollar cost averaging, we think, is one of the best solutions. It basically involves drip feeding your money into the markets gradually over time. And why it's such a great strategy is it helps you avoid the potential for regret. And how this is done is that if you're investing slowly over time and the markets fall, you feel happy because you get to buy shares at lower prices. So you've been able to buy shares on sale or buy investments on sale. And if markets keep on rising, you're at least pleased that the first shares that you bought have gone up in value. So dollar cost averaging is a way of managing your emotions in a way that will help you slowly become invested over time and be less obsessed with whether markets are going up in the short run, because it won't affect you as much. The final tip is one that really underscores our philosophy at Stockspot, which is that investing should be simple. There's a lot of charlatans out there trying to sell complicated trading strategies and investment strategies that typically cost a lot to manage. But the evidence and the history shows that the more you do, the less you get. And conversely, the less you do when investing, the more you get in returns. And I think this chart really shows that in a lovely way. So this was a study that looked at 50,000 brokerage accounts in the US over 30 years to look at how they performed compared to the market itself. And remember, the market is what you can access through an ETF. And what they found is that the average investor in the US earned 7% per year less than the market. And when they looked into why this happened, it was typically because the average investor, as much as they try not to, there's such a strong temptation to chase markets when they're hot, to be frightened when they're falling and to sell, to overtrade, to pay too much in brokerage. And all of these actually come out of your return. And funnily enough, the group of people who did the best out of this survey were one of two groups. One were people who had forgotten about their brokerage accounts and so had done nothing. And the second group were people who had passed away, which really shows in a slightly morbid way that when you're investing, doing less is what's going to get you better results. And avoiding the temptation to do more is really what's going to set you on the right path. So with that, I'm happy to open up to questions. I think there's one that I've received, and I'll see if Sarah or Lauren have any others that have come through. I believe Lauren's also been answering some questions as we've been going. So the first question is a question about rebalancing. How often should we rebalance? So this is a question we get often from clients, and it's not something I explained in detail here. So when it comes to rebalancing, there's a few different ways to think about how often you should do it. The two schools of thought are time-based rebalancing, which means that you rebalance every period of time, and that might be every 3 months or 6 months or 1 year. This is good because it helps you set an alarm to rebalance. However, the problem with time-based rebalancing is that often over periods of 3 months or 6 months of a year, markets may not have moved very much, or markets may have moved in the same direction together, and so rebalancing isn't really required. And the other problem is that during that 3 months, there may have been big market moves that you could have captured if you were more active in rebalancing in that time. So rather than time-based rebalancing, what we employ is what we call threshold-based rebalancing, which doesn't really care about when you're rebalancing, but it actually focuses more on how far away the investments have drifted from their target allocations in your portfolio. Our algorithm is monitoring this all the time, and when an asset moves far enough away from the target weight in a client's portfolio, we will sell the asset that has performed well and reinvest it in the asset that has performed not as well. Now, in terms of how far we will let that go, again, there's benefits and disadvantages to doing it in different ways. If you rebalance too often your portfolio, what will happen is that you really don't capture any of the medium-term trends in markets, and you're also costing a lot in transaction fees and slippage, which isn't great. But then if you take too long to rebalance, your portfolio gets too risky. Now, the data and a lot of the academic work that's been done in this area suggests that the best way to look at rebalancing is when your portfolio, or when assets within your portfolio have drifted somewhere between 15 to 35% away from their target weights. So, for instance, if the target weight in your portfolio for Australian shares was 20%, and you had a 20% threshold, then Australian shares could get from 20% to 24% of your portfolio before you'd consider selling any of that. And this is the type of rebalancing strategy that we employ. We look at each individual asset, we look at the weight within the portfolio, the volatility of the asset, and then we set threshold-based parameters to decide the best time to invest. But that isn't a decision we make. It all happens automatically with the algorithms that we've set to rebalance for clients. The second question we've got is around dividends. The question is, do ETFs pay dividends? And that's a great question. And the answer is, it really depends on the ETF. So within our portfolios, most of the ETFs do pay dividends because they're typically share market ETFs or bond market ETFs. Share market ETFs either will pay dividends on a quarterly basis or a half-yearly basis. And we invest in ETFs that do either one of those. Fixed income or bond ETFs, again, will pay distributions on a half-yearly or quarterly basis. And then there are some ETFs out there that don't pay dividends just because that's the nature of that ETF. For instance, the gold ETF in our portfolio doesn't pay a dividend. Gold doesn't pay a dividend. But to go into a little bit more detail on how the dividends work, what will happen when you own an ETF is that 4 times a year, you will receive a dividend, and inside that dividend will be different components, just like there would be if you owned shares in Westpac or BHP. So you'll get some a cash component of your dividend, you'll get some local income, you might get some overseas income, and you might get some franking credits as well. And it's a common question we get from clients is, will I still earn franking credits if I own ETFs? And the answer is absolutely. If the shares you're investing in originally paid franking credits as part of their dividends, then an ETF investing in those same shares will also pass on those franking credits to you. So an example of that is the Australian shares ETF that we invest in, which is the Vanguard Australian Shares ETF. It paid a dividend last year, and it was a 80% fully franked dividend, which meant that we also passed on to clients a piece of franking credits that they were able to lodge as part of their tax return. And that's also another point to make with ETFs, is that if you invest in ETFs, you will receive a tax statement from each ETF, which breaks down the component of each of the dividends they've paid throughout the year. Now, that's something, if you're doing your own tax on eTax or you have an accountant, you can pass on to do. We've built now technology that actually combines all of those statements into a single statement for clients to save them the hassle of having to combine all of those statements. So ETFs are a lot easier to manage than direct shares as well. If you had a portfolio of 20 shares, that's a whole lot of dividends to manage and to calculate each year. If you just own a few ETFs, that's only a few statements. Or if you use a service to invest in ETFs, then you will just get a single statement that you can roll up into your tax. Now, I think that's the two questions that we did get that haven't been answered already by Sarah. And if there are any others that have come up, I'll endeavour to answer them via email. Thank you very much, everyone, for participating in today's webinar. Hope you've enjoyed it and learned something from it as well. We'll be sending a follow-up email, I believe, tomorrow with some more information around some of these topics. And if you have any further questions, feel free to email either myself, chris@stockspot.com.au, or our client care team, which is inquiries@stockspot.com.au, and we'll try and answer them for you. So thanks very much, and enjoy your evening.